In today's video, we're going to talk about option Greeks and specifically about option the Greek delta. So delta, by definition, is the rate of change of a value of an option contract with a $1 change in the underlying. Now, I like to think about the D in delta as the driver of a car. So as the underlying moves, the delta drives the price in either direction. They'll drive it up or down depending on what the delta is for that specific contract and how much that underlying actually moves. So if we look at GLD, this is the ETF for the gold shares, we can see that the current underlying price is 153.67 roughly. So if we look at, I've eliminated everything on here. So it's just the delta, the mark, which is the midpoint between the bid and the ask spread. I just wanted to eliminate everything else on here. So it was a lot less noise on the screen. The basic chart setup on this is that calls are on the left and puts are on the right. We can see that this looks a little bit backwards because the strike prices start off lower, the higher you go, and then they increase as we go down on the page. Anything that's in this bluish color is considered in the money. So we have our in the money options on the call side, which are below the underlying. And then on the put side, you can see that the deltas are negative because this is an inverse relationship between these two because these are considered in the money being above the underlying. So we'll talk a little bit more about that relationship later. So looking at the delta, we can see that this at the money delta right here is roughly 50 or 0.49. On this one, everything here, if for these deltas, we always just refer to them as a 49 delta, because when we talk about the shares, the number of shares in a contract, we have 100 shares in this. So looking at the deltas here, we can see that the deltas, when you go out of the money on the call side, they go all the way down to 0. Continue scrolling. And as we go deeper into the money, we'll see that they go all the way up to 0.99 or 1.0. So these deltas have a highest value of 1. And if we look at something that's just out of the money here, we've got a 0.28 or a 28 delta. Anytime that we start moving closer to the money, we can see that this contract right here with the delta is the 1.46. If we add the 0.28 or 28 to that, we can see that there's a roughly 28-cent increase in this contract as we move closer to the money. Same thing with this 32 delta. When we change from the 158 strike price and that contract value increases, it will jump 32 cents from here. And this one, actually, the math works out pretty perfectly on this. It'll jump 32 cents from this to this. As this blue line continues to move down on the call side, as the underlying continues to increase, and this blue line will drop and drop and drop to here, you will see these numbers will continue to change, and this contract value here will continue to increase. And as we get closer to the money, the velocity or the magnitude of this increases. So it doesn't just stay 32 cents on the increase. Once it moves up to the next strike price, this will drop down from the 153 option to the 154 option. So this line will become blue. This contract will become the 28 cents here, or roughly there around that area. The 24-cent will drop down to the 161, and it'll just be a domino effect as this thing comes down as we get closer to the money. Or inversely, if this blue line, if the underlying continues to drop, then all of these valuations will continue to drop as well by 40 cents down to this one, 36 cents down to that one. And as it continues to move around, you'll see this is why I like to reference delta as the driver, because it drives these prices either up or down with every move in the underlying. So these options themselves are considered leveraged instruments. So one option contract controls 100 shares of the underlying. We can see that the 100 is represented on here. It controls 100 shares of this. So roughly, if we move the decimal point over 2 spaces, that'll be $15,355 that this is controlling. And when we look, the reason why the deltas can only go up to 1.00 is because if we took a 1.00 and we move the decimal point over 2 spaces, that gives us 100. Now, when we get to a delta of 1, we are moving essentially in lockstep with the market, penny for penny, dollar for dollar. As these strike prices move around or the underlying moves around, we are controlling those 100 shares of that underlying. So if we look back to the 49 delta, when we have the 1.0 delta, the 100 delta, every penny that the underlying moves, we're going to gain that penny on our options contract. If we're at a 49 delta, it's like we're controlling 49 shares of that underlying instead of the 100. So we're only going to be moving half. So if the underlying moves one full dollar, we are going to gain $49, 49 cents on that. So we'll gain half of it. If we move further out, we have a 10 delta. If that underlying moves $1, we're moving the 10 cents because we're only controlling 10 shares of those 100 shares. So that's how that delta starts to move us around and how it controls that. So every time you look at the delta, we move that decimal point over 2 spaces, and that gives us that change for the entire valuation of the contract. Everything on here for the one contract is divided by 100. So if we were to buy an options contract on this for $3.30, then it would actually be $330 because this decimal point would be moved over 2 spots. So as you can see, we go deeper into the money, higher valuation, higher movement of the contract value. As we move further away, we see less. Same thing on this with the put side. The further into the money or the higher that we look on this, because we're already in there, it goes in the negatives, and then the opposite can be true going in the opposite direction with this. So delta's moving up and down in both directions with this. So we showed the example with this with the math. If we move up the 0.28, it gets us into here. Now the math doesn't always look like it works out perfectly. And that's because when the Greeks are calculated, they're calculated with 4 digits. So you may see this 0.24 is actually 0.2417, or it could be 0.2384, but they round these numbers. So that's why the math may not look perfect on here. Or if you're looking at the market after hours, a lot of these numbers are not 100% accurate with that. So delta also has a second characteristic. It not only gives us one of the, it's what's considered a price derivative, but it also gives us a probability that this strike price will end in the money. So if we look at the 24 delta on this, it is essentially saying there's a 24% chance that this strike price will end up at this blue line in the money here. And so you can see that as we look deeper in the money, there's a higher probability that it's going to end in this, right? So we go all the way up to that 100% chance that it's going to be there on this side. Same thing with the put side. If we look on this, so this is essentially saying that we're, as a put, if we buy a put, we're assuming that the underlying is going to decrease. There's a 100% chance that the underlying will not reach $171 on a strike price by November 18th of 2022. So looking at the 50 delta or 49 delta, you can see that right at the money here, there's a 50-50 chance that it's going to end here at expiration. So it's basically a coin toss. There's a 50% chance or 49% chance that this thing is going to either flip back and forth between the 153 and 154. So on that, if we look at, because all options contracts will eventually expire. So we've got this one is 32 days out. If we look at the $140 strike price on this, and we're 32 days out from expiration for that, we can scroll up. We're in expiration week this week. So I'm going to drop this down. We'll look at the 140 on this one as well. So the 140 on this one is actually just changed over to a 99 delta. You see, we've got several more of the 1 deltas up here, 100 deltas, but the 140 here is bouncing between 97 and 99. So we've got roughly a 97 and 99% chance that it will end in the money. And you can, if you picture this, as we get closer to expiration, it's like a band that is constricting on all of these strike prices. So we're looking at the 140 on this. We're 4 days out. It's roughly a 97 delta. We'll minimize this. We'll look back at our 140 and we're at a 88 delta or 88% chance it's going to end in the money. So as we get closer, that band starts to really constrict. Another thing we can look at on the top right side on the Thinkorswim platform is that this is what the expected market move is in these 32 days. Is a $7.26 move potentially. So we can see that this is really starting to narrow down here in the closer expiration or closer that we get to the expiration. So we're looking at the November. So if we scroll down and look at the December expiration on this at the 140, so they give us actually, we do $5 strikes on these as we get closer to this expiration series. Then we'll start to see these will start to spread out and get more options here. No pun intended on that. But the 140 on this one is an 83 delta, and the calculations that they're using say that this could potentially move by almost $10 on the change on this. So this is why we're still seeing an 83 on here, an 88 in this expiration series from November, and then we're seeing that 97 or 98 on the other expiration that's going to expire in 4 days. So these out of the money contracts, you can see they decrease almost down to zero, because it's assuming that there's a 0% chance that this underlying will reach the 200 strike price. So, and then opposite on the put, as we go further and further down, there's a 0% chance that this underlying on GLD will drop down to the 115 strike price. So if we look here, let's select the 50 delta, and we'll just we'll put on here just a quick single buy. So we'll buy the call option. You can see that on here, this dropped down to the $3.35. Did not ask for the mark or the mid price. It went to the ask price. Anytime that you're going to buy an option, you're going to be looking at the ask price. And anytime you sell an option, you'll be looking at the bid price, just the way the math works out on this. So we've got the 154 strike here. We're in the November expiration on this in 32 days. This is going to move unless you click the lock button or you try to adjust this. If you end up trying to adjust this down and then you want to go back with how the market's moving, you just click the unlock button on this side here. So if we look at our price slices, you can see that the delta, they moved that over because it's taking into account the entire contract, which is the 100 shares. So that 0.49 is actually, if we were to expand this out to 4 digits, it's 0.493842, however you want to look at it. But this gives us our 49 delta, or 49.42 delta. So on that, that's how much this contract value will increase if we were to move up $1 in that underlying. And it doesn't have to be a full dollar. Every time this thing moves by a penny, you can see that this is a lot faster to react, right? So this is moving because the underlying is moving around by a couple cents here and there. So that is why we see such a fast change on the farther digits out on the delta, is because no matter what, it's not just a full dollar move in the underlying, it's pennies at a time that this thing actually will change the valuation of the contract. So we referenced that. It's the 100 shares on that, and that can be for or against us. If this blue line starts receding away from our option that we've bought or sold here, then we'll see that valuation change. So then this will jump and this will jump, and then the prices will change. And as an option buyer, we are always looking for the valuation of our contract to increase. That's how, as an option buyer, we make our money, is by the value increasing. So you can see as the underlying increases on the call side and starts driving down, that will make this number bigger, and then bigger and bigger and bigger, and it will continue to increase. And that's where we make our money. As an option seller, we're hoping that if we sell this contract here, that it will recede, and then this number will continue to drop and drop and drop and drop. And then when we buy that contract back, that's where we make our profits on it. So let's look at the P&L chart real quick on this. I prefer to stay in the Analyze tab because I can just easily bounce back and forth between the simulated trades and the risk profile. So we'll look at the risk profile on this one here. And you can see this was what would end up happening. We were looking at the 154 strike down here, which is where this contract would be if we were to buy this option here, which is right at the bottom of this curve where the profits start to increase on this side here. So we would end up paying $3.35 for this contract, again, times 100, so $335 for this contract. You can see these two red lines. So there's a red line on the purple and there's a red line on the blue. As you move your mouse across the bottom, you can see on here, this is November 19th of 2022. So that's our expiration. So at that date, or on that date, this blue line here will represent what your profits and losses are. So we have our zero line across here. Anything above that is profit. Anything below that is a loss. So at expiration, if this underlying moves down at all, we're going to have paid or debited the $335, and that's just gone. We won't make that back. If we need to get up past this red line by expiration in order to start making a profit. The purple line right here represents what it is today. So you can see on the bottom, the purple here is 10/17/2022, which is today. And this red line here represents our break-even point. And when I reference the market, you can see it's kind of moving a little bit. I see the market's breathing because every time volatility changes, supply and demand increases, decreases, you see the underlying start moving around, which is representative of this line here. You'll see this purple line will start moving up and down. And it essentially is breathing. It's alive as it's moving around. So that changes what your profit is. And you'll see that there's other things that affect it, like theta or time decay, which we'll get into at a different video. But if you take this all the way through expiration, in order for you to reach this red line right here, we have to do a little bit of math. So if we look at our strike price that we bought at 154 and we add what we paid for it for the 335 plus the 154 gives us 157.35. So we'll go over top of this. 157.35 covers up the line. 137.34. So that is our break-even point at expiration. So in order for us, by the time that this thing expires on November 19th, this underlying needs to move up above this line. You can see that as a single option buyer, if it were to have the magnitude or the velocity going forward, you would see your profits could be potentially unlimited, right? Is what they always say, but there's always a limit. The stock will not go from 159 all the way up to 3,000. It'll always trade within a range. You can see on here the upper end of this is a 10% move, which would be pretty significant in 30 days. But you could make on a single option $1,100, but you need that to move high enough or low enough if you're buying a put option to be able to make a difference. And you'll see this purple line. Maybe if this thing jumps to 155 tomorrow, you'll make a quick $90 profit on this thing, minus whatever theta decay, and then you can sell this thing back and make a little bit of money on this. So those are the break-even prices. Again, you have to take into account commission fees for any of that stuff. If we look at this, right, we're looking at this, maybe $335 is a little bit too much money for you. So, and you're going down and you're looking, hey, I'm gonna go with a smaller delta because that way it's cheaper here. I can go with the 165 option. So I'm gonna get rid of this, and then we'll go to the 155 strike, or 165 strike rather, and we'll buy this option at a single. So that's only going to cost us 52 cents for the contract for the 165. But if we look at the risk profile on this thing, we're currently trading right down here. We have to move in order for us to make a profit. We have to reach not only our strike price, the 165, we also have to go an additional 52 cents on this so that we get to the 165.52 because it's the strike price plus the debit on that. And then for an option seller, it's the debits and credits, same thing. We do the math on that. It's pretty simple to have our break-even points. So yes, you could go into an option contract as a buyer for a lot cheaper, but you really need that market to move up into here and then continue on going from there. So if you're an option buyer, you're really hoping that it will move in your favor. If you're a call option buyer, it needs to go up. If you're a put option buyer, it needs to go down. And then if you go the further out of the money you go, you can look at the deltas. You can see that this is like controlling 10 out of 100 shares. This is like controlling 49 out of 100. And the deeper into the money you go, the more momentum you're going to have behind every penny, nickel, dime, dollar move within the underlying. So hopefully that helps a little bit of understanding with option delta and how it works. If you have any questions or want any other videos, please fill it out in the comments section below. Thank you.